Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you, intro man. As reliable as ever. We haven't been as reliable, and I apologize for that, everyone. That had to be juggling around the schedule. We got everyone traveling at the same time, so it's been tough to get a group together. But we got our man Patrick here with the Part-Time Investing YouTube channel.
Welcome.
And I realize I have the intro loop going. My mistake. I'm rusty. It's been too long. But got Patrick here with the Part-Time Investing YouTube channel. And Patrick was the one who I spent the most time with at the Berkshire Hathaway annual meeting weekend. We spent pretty much all Saturday together and had a good time. So we'll be talking more about your approach, Patrick. I know you're a big microcap guy for the most part, so, or at least tend to fall in that direction. So we can talk about kind of that approach and all your other philosophies on investing or whatever you're comfortable sharing, I suppose. And definitely go take a look at Patrick's channel if when you get the chance after the show is done, of course. We are on a new time today, so for anyone tuning in live, welcome. I'm not sure if we've seen you before because we usually do Friday nights U.S. time, but it's Saturday here in the U.S. today, and we're going to be trying some new times as we kind of work through some things and kind of see what works and see if we can try to get some more content out as well. We plan on having some more kind of midweek episodes, pre-recorded shows as well coming out in the near future. So stay tuned for that. And to that, be sure to subscribe so you don't miss any of that as it all comes out. And check out all the other good stuff in the description below. I forgot to mention that. I shouldn't do that either. Smash the like button, and I think we're good to go. You tell me, Patrick, how you doing?
I'm doing good. Whenever you asked me to be an alternate, I didn't think I'd be like the only one, but yeah, worked out.
Yes, I know. Well, I was expecting at least one more today, but you know, it's life throws whatever it throws at you, and I thought it'd still be good to have a conversation about all sorts of things because I know you've got you've been in this investing game for some time now, and I like the way you look at some things, so I thought it'd be fun to talk about investing generally. And I guess why don't you introduce yourself? Where you're from? What are you doing? And all that good stuff.
Yeah, so I'm Patrick. I run the Part-Time Investing channel. It's just me. It's been kind of spotty recently. I think real life's just gotten busy, but I guess it's just a value investing channel where we focus on following, or I guess doing valuations on individual companies like over and over. I think that's the best way to practice that sort of thing. It's kind of like what, if you listen to Warren Buffett, he said that's what Ben Graham's class was just taking individual companies, doing valuations and going through every scenario and stuff. So I just try to do that. And it's worked out pretty good for me as far as just like helping me understand investing more. And I think, other people have enjoyed it too. The people who subscribe seem to like it. So
yeah, I like the way you present the stuff there. The way you kind of set it up on screen is really nice. You got valuation metrics, kind of your calculations you're going through, and then you obviously talk about the thesis in general. But yeah, it's a nice format, so it's good to see it doing well.
Yeah,
and is that, I assume that's just kind of a side hobby thing?
Yeah, it was mainly a hobby. Well, I can't say the word hobby for tax purposes, right?
Yeah, of course.
it's the channel is an LLC, yeah. So it's
yeah, same here.
It's a part-time thing, right?
Part-time investing, right?
Yeah, the idea, and I think I got it from Peter Lynch and a lot of Warren Buffett and stuff, is that I think there are advantages that individual investors have over like Wall Street, and I think highlighting those and shows that you can actually probably do better investing part-time than if you spent every day doing it or every second like a day trader or something, you know.
Yeah, having some real life perspective, paying attention to things around you, it makes sense. And to that, I know you're a chemical engineer as your career. Do you find yourself looking at a lot of those stocks first because of that, or not so much?
Yes. Now I will say those are the ones that I've done the worst on. Yeah. So I think that it's almost like, I don't know. Yeah, I do spend most of my time in that area, but I would say what I've done good on is in general just industrial stocks. Whenever it gets to the individual like chemical companies, that's where I haven't done as good. But just overall, U.S. industrials is where I focus a lot of my time. So
yeah,
I would say almost all of my time. So it's worked out really well. So
yeah.
I think staying in your field is good because you kind of get insights into. You may see things before, I guess Wall Street in a way, if you're from ground level.
Do you find yourself looking at a lot of smaller companies because of that, or do they tend to range in all sizes? And we're supposed to talk about microcaps. That's the
yeah. I mean, so my biggest hit was a microcap, and I'd say I mean, I have a couple. I have one that started as a microcap, but technically isn't now, which is good because it helps.
Great.
Yeah, I think it might still be, but that's kind of that goal, right? I think that a lot of them, and we're going to talk about it, but I think microcaps offer a lot of they're often overlooked compared to the other stocks, So.
I guess we should probably define microcap first. Is there? I forget if there's.
So the official is.
Yeah, what's the official definition for
it's
size?
50 to 300 million. Under 50 is a nano cap, and that has been nano. I actually have invested in a nano cap company. I'm not going to say it here because I don't want to. It was like a $7 million market cap. And
pump the stock.
yeah, I'm not going to do it, but. It was an experience. Talk about very illiquid. I would, you'd have to set a limit order, and it might not fill for a week or two. And it was like a classic balance sheet buy. But then they just started losing money every quarter, and I was like, man, it's still 1/8 of tangible equity. And I remember that quote from Charlie Munger where he's talking about why Warren Buffett changed. And he said something like, it sucks whenever you own a company and you're sitting around waiting for them to liquidate, or you're hoping they liquidate before they lose all the money every year, and that's kind of how I felt. So then I tried to exit. And then that was just,
and then that
like I said, if the limit orders were a pain on the way up, they were worse on the way down. I mean, it was so crazy that whenever I was buying it, it was literally raising the stock price 20-30% on the ticker. I'd be the only trade for that day, that sort of thing. So it was a fun experience, but yeah, that was a nano cap.
That seems weird. Why they would even trade publicly? Because there's a big regulatory burden there.
Well, they were unlisted, so they had made the decision to delist because they didn't think that they were getting the support from the public markets that they wanted. So it was a pink sheet thing, which is, and they had I had to email somebody for the 10K and stuff like that. I made a decent profit on it, but nothing like I wanted to,
So, for all the trouble.
Yeah. It's 20%. Yeah,
that's pretty wild.
Yeah.
Was that a local company? How did you even find it?
I found it by basically going through a certain sector and sorting by just literally going like Warren Buffett says, look at all the stocks in alphabetical order and go down. And I found that one and just started kind of looking into it more. And so my problem is that I see something and I think everything's the best idea ever at first. So
yeah. I think that's hard. That's something I struggle to shake too, especially looking at small businesses now. Nano caps.
Yeah,
there's a couple 100,000. I know we've looked at some stuff together too. Haven't pulled the trigger yet, but when you're dealing in that world, it's easy to get caught up in kind of the sticker price numbers or the brochure and all that. It's very easy to get caught up. You see a lot in real estate as well, where they advertise a certain cap rate or whatever, and then you actually do the real numbers this deal's awful. But until you get in the weeds, which takes time, that excitement can kind of get you in a place where it's a little tough to get out if you don't pump the brakes a bit. I definitely, that's one of my number one challenges is looking away from things and trying to consolidate into what really are the solid ideas. It's hard to know when you don't know what you don't know. It's tough.
Warren said Charlie he called him the abominable no man, because he would everything,
Yeah.
every idea Warren said, Charlie's first response was no.
Yeah.
No. And I feel like you need somebody like that.
Yeah.
Just say like, this is the worst idea I've ever heard. And then, at least get you off of that initial optimism. So.
I mean, I deal with that. I think, it's the biggest challenge for me right now with that sort of phenomena is employees. I tend to be very optimistic that things will turn around or whatever, but once a habit is set, it's very hard to break it in either direction, really. It's hard to change people. And I tend to think like, if you just do the X, Y, Z, they'll be good. But if motivation's off, if they just don't want to change their habits for whatever reason, if they got something else lined up, it's very hard to break that. So I'm trying to shake that right now. It's not being overly optimistic. If something smells off, just gotta back away. Mm-hmm. There are plenty of people out there. It's tough. Applies well beyond just stocks, but within companies as well. Trying to say no to lots of things. Tons of opportunity out there.
Yeah. The good thing with stocks is that if you made a mistake, you can just get out of it versus like,
when it's not
employee stuff. Yeah. That's what I love about investing is like mistakes they're very easily reversible,
Mm-hmm.
So you can.
Most of the time, if the mistake's not too big.
Yeah.
Usually if there's not leverage involved, then it's easy.
Well, yeah. Yep. Exactly.
When you lever it up, it can get a little tricky. Speaking of debt, do you need like real estate, or is it just kind of all stocks for your portfolio?
No, 100% stocks. Yeah. Except my house. Yeah. So,
yeah.
And individual stocks. I think that just offers the best return. Like if you look at, even if you see something selling at, let's say, 5 times earnings, that's what, like a 15-ish% internal rate of return or something like that. And you might not get that. And that's assuming it just stays at that, same earnings. If it's growing, that it's even more, appetizing. And it is, especially how the market is right now, everything's down. I just feel like in the stock market, I feel like there's deals out there for getting much more on your money than like, I don't know, whatever, 7% or 10% on real estate. Now, if you leverage in real estate and you get the depreciation, now like your cash on cash might look better, but I'm not a big debt person. I think I was actually raised like a Dave Ramsey baby kind of, and it was, and I've kind of gotten past that, but I still hold on to some of those, hatred of debt type things, So I think that's something I do have in common with like Warren and Charlie, I would say is I never like that always spooked me to go into debt with stuff like that. So
yeah.
Maybe I'm not taking enough risk, but
no, I wouldn't say that because it doesn't, like if you can add debt to any equation and like it'll make your upside a lot higher usually, as long as you're getting an okay deal on the thing and the interest rate isn't higher than your yield, which we're seeing a lot in real estate right now. But then you're playing a different game. You're now playing a debt game. You're just introducing another factor into the equation, and it's straight up like you add more debt, you're adding more risk, you're adding more potential return, and it's the opposite on the way down. So it's just a comfort thing, really. If you're not comfortable with it, you're probably going to end up making more mistakes. And if you're too comfortable with it, then the debt itself might be the mistake. So I really don't think there's a total right answer because debt makes the whole situation more emotional, and depending on what you got at stake, that could be a lot of emotions. And even if you don't have a lot of it at stake, you just don't want to bother. Like that's fine. If that makes you more effective in the first place, you don't have to worry about this thing, then that's all the better. I'm trying to deleverage a bit as we move forward, or at least, get better terms and kind of really focus on using debt only in kind of a great deals situation where, if you, like in the business sense, if you can get like great seller financing at great terms with limited interest, like that can make a lot of sense. But especially now with interest rates climbing, it's tougher to use kind of more conventional means of debt and still have it work. But It's, I think just trying to use it opportunistically is probably what makes the most sense. But
well, that's
well,
I was gonna kind of go off of that and tie into the microcaps a little bit.
Mm-hmm.
So, like, one of the things I think that's super important with microcaps is that, like, if you're looking at a big macro cap company or something, they're not going to go bankrupt, or I mean, I guess they could, but like somebody like Google or Microsoft or Apple, like they're not gonna, they won't go to zero. I feel like your risk is probably just having a stagnant investment for 5 years or something like that.
Sure.
But whenever you're looking at the small cap stocks, I feel like the traditional value metrics are super important. So like, debt is one for sure. Like, especially I think from 2008 until now, a lot of companies got by with a lot of debt because every time it came due, they were just able to refinance it, and it was still interest rates were low. But now, now interest rates for junk bonds and stuff are, they're going from like, they were at like 5%, 6%. And now you're looking at like 13, 14 if they want to refinance it. So it's,
right.
That's something that I'm very scared of whenever I'm looking at small cap stocks for sure. I think it can.
It skews all the historical data too. It's like that environment, especially for a smaller stock, might have been just so wildly different. If we're looking at like 2012 numbers, like, wow, they've grown exponentially up until today. Well, yeah, because they're in a decreasing rate environment that entire time. So it can be pretty misleading. There's a lot of debt involved. So yeah, I hear you there. And does it change the equation that much, I guess, for you, whether it's a rising or falling rate environment? Let's say rates got up to 15%. Would you then be like, well, they have high debt now, but if I expect rates to go down, or do you not even like factor that in at all?
No, I don't factor. No, I was, well, okay, let me say this. I look at interest rate as a percentage of operating income. I feel like that's really good to look at.
Sort of like a debt service coverage ratio sort of thing.
Yeah, like or did they have enough operating income to easily meet their interest payment every year? And that's do I have that book here? Yeah, okay, it's up there. But quality of earnings is one of like the most underrated investment books, I think. And it's like I think it's by somebody last name Thornton, but he basically like shows you how to look into company 10Qs and stuff like that to look for fishy stuff in accounting. And I feel like debt is a big one. And that's he preached that ratio, that interest payment divided by operating income. And I think I go over it a lot on my channel. I feel like there's two ways to look at debt. You can look at it like that, or you can look at it from a like overall perspective, like the debt to equity ratio.
Yeah. And the balance.
Yeah, I mean,
balance versus
both
payments
of those. I'd rather both of those be low. That's
of course.
Yeah, and and I just don't buy the whole good debt thing, especially for companies and stuff. Maybe for individuals, but
it really depends. It's a terms thing. If the kind of what you're getting at, if the balance is really high, but the term is 100 years, they can meet the payments easily. It's not as big of a deal as if it was, a smaller balance, but over 1 year with variable rate interest, or, you got all these extra risk factors, and the terms matter is really all I'm getting at. I think the quality of earnings book, I want to say I saw that it was like required reading for anyone who joins Bill Ackman's team. That's on his list. It's on a bunch of people's lists, but I think that's where I last saw it. I haven't read that one yet, but it's
really good.
It's on my list. So
I have like a full outline to do a video on it, but just never got around to it. But I have the outline.
Yeah, I've got many outlines too. Never got to it.
So I guess what else were you thinking about small caps, because I have a ton of notes on what I think the big differences are between small caps and macro caps.
Well, if you got the notes right there, what do you got?
So I think another thing to be suspicious of is that like a small cap that's been a small cap for 30 years. If you so let's say that just like let's not including buybacks or anything like that. Even if you were growing at like a 7% rate, for I said 30 years, right? So that's like 7.5 times in 30 years. So if you were like at $100 million, $200 million market cap 30 years ago, and now you're only at like 300-400 million or something, to me, that's suspicious. And I see a lot of small caps like that, and unless there's a change in management or the macros changed, which that's hard to predict, but
sure,
that's another thing I think to look out for. But what it really leaves you with, though, thinking like that, and there are some old companies that are kind of getting a new wind, but there's also a lot of old companies that think they're getting a new wind and they're actually just going to tread water for the next 20 years again. But it really leaves you with like,
what do you think would cause something like that? Just management incentives not being aligned, or just bad business in general?
I think that's the most likely outcome. Is just complacency and stagnation. I feel like the growers are the abnormal, like those are out of the norm. And so I think businesses tend to deteriorate. So just maintaining it is strong in itself, but it's not. I mean, if you're an investor, you want to look for stuff that's growing.
Yeah.
But it leaves you with like young companies in a way, for like for microcap stocks. And I think or micro and small cap stocks. I think the problem is that now you have like the hype train sometimes that you run into if it's like a fresh company, and and
that's certainly what we've seen recently in the last.
You have to
recently, last call it 10 years.
But so I think that's interesting. Because now you're talking about, you're looking at a growth company instead of if it's small, because that's why I feel like in general with small cap stocks, you're compared to macro, right? Your chance for a 10 bagger is almost zero with somebody like Apple in 5 years, right? They're not going to go to what are they, like almost 3 trillion now?
I think it's 3 trillion. Yeah.
Yeah. So, I mean, that would be, I think the GDP of France is like 3 trillion or something like that. So they'd be, or I don't know. It's they're not going to go up 10x.
Quick pet peeve. I don't like the net. It's market cap, which is really kind of like a net worth number compared to GDP, which is like a production number. I never liked that.
Okay, that's fine. But I guess what I'm saying is that like these companies they don't have the capability, barring buybacks and stuff like that.
Yeah, right.
The stock price might go up. It's probably going to go up more than, it's definitely going to go up more than the market cap in like somebody like Apple's case. But I think that your chance of getting a 100 bagger, let's just say a 10 bagger in the next 3-4 years is much higher if you focus on the smaller caps. Now, I think that there's a lot more that are going to be duds in general. And I think that that's kind of like, and I've heard Monish Pabrai talk about this, where like in capitalism and just in the universe in general, kind of like the rich get richer, right? So the big companies they're big for a reason. They're they have the tools to succeed, to grow and stuff like that. And then they're going to continue to do that. And like I said before, the small cap's a small cap for a reason, usually,
Yeah.
So it's much more of a needle in a haystack, I guess, exercise for small caps. So. I feel like large caps much safer.
In quotes.
Yeah.
Safer in quotes. No, that makes sense because business is difficult, and when you're looking at mega caps, you're already kind of looking at winners. I mean, no one really ends up winning because the game never ends, but it's very easy to see those because they're so big. They're top of the index. Yeah. They're selling the most products. They're in the most people's homes usually. So it can be easy to be sort of distracted by them. Not that they're bad by any means, but it's a different, like you're saying, you're not going to get the 15 bagger. At least the chances are very slim without a lot of monetary policy.
Or a ton of buybacks. Yeah.
That's right. Or some sort of massive, just like unexpected tailwind.
Mm-hmm.
How do you sort? How do you sort from all the rest? Or are there any big red flags? You kind of mentioned the debt situation. You mentioned the stagnant company that's been stagnant for 30 years. Any other red flags you kind of look for, especially with microcaps?
Yes. Okay. And then I want to address a comment too. And
have at it.
Yeah. So definitions. Nano cap is going to be under 50 million.
Yeah.
Micro 50 to 300 million. Small cap 300 to 2 billion. And I guess mid is 2 to 10, and large is technically above 10 billion. And then I think your FANG, or it's not FANG anymore, but like macro cap stocks are over $1 trillion or something like that.
That's crazy. There's more than one of those now.
Yeah.
Cool.
So red flags. And I would say that this is what my entire channel is about, is literally looking at every single company or like looking at companies and just doing a deep dive and looking for any red flag possible. And I have a video where I talk about a checklist, and that's on there. But I feel like management is very important in small caps. And I think in general, having insider ownership is, you're much more likely to have insiders as a significant holder in a small cap company.
Right.
And I'm talking like 20-30% sometimes.
Or even majority in some cases.
And the other issue though is that things like compensation of executives are a much higher percentage of the earnings, compared to big companies. Because if you have a company making billions of dollars a quarter, compared to one making, $10 million a quarter, what the C-suite makes is going to be a much bigger chunk.
Right.
And, so I think you really have to look at the stock-based compensation and stuff or not just compensation in general, but I see the comment about stock-based compensation too.
But just executive comp in general.
Yeah. And I think one thing, we talked about debt, I think in general, looking at, I don't know, I judge companies a lot by I would say the earnings calls, but some companies I invest in don't even have earnings calls because they're so small. But I guess you want to see management that sets a goal and then they make progress towards that, and you can actually see it, and you can go back a couple earnings calls before, sometimes it's PowerPoints before, and see, okay, this is what they said they were going to do 2 years ago.
Right.
They're actually moving towards that. That's one. And then I would just say from a PE rate, obviously from a cheap thing, you look for something selling in the single digit PE with double digit growth. That's like I think that's a good kind of starting point. So
that
makes sense. About that too. Yeah.
Saw this comment from Hoda Prime. I saw one company where a wife and a husband ran the company at $1 million in salary each, and they leased a property to the company for another $1 million. So that'll probably be a bit more common, or maybe not more or less common, but more impactful, which is what you're getting at, than if it was at a mega cap or something.
Yes. No, exactly. Yeah, because that company's probably making $2 million, or something like that.
Yeah. And people are asking for your channel, Patrick, but it's part-time investing on YouTube. But please don't go and check it out until after this show.
Yeah.
You got Patrick himself here right now.
I know, and I'm never live, so this is I don't know what's going to happen. My videos involve a ton of editing, so
they're well done. They're well done, like I was saying earlier. It's a good product.
Territory for me.
Yeah.
Bill O'Reilly doing it live, man.
Do it live. So we talked about executive comp or just compensation in general, expenses, I guess. And any other like
I'll tell you a huge one. Okay, here's a big one. What do you call it? Not just high Capex, but Capex that's very essential to just stay afloat. Like you want a company that's doesn't require a lot of
ongoing maintenance.
Yeah, exactly. Yeah. Forced Capex, I should say, and the way to look at that is free cash flow. But now if you look at free cash flow, now you got to factor in stock-based compensation and stuff like that. So it gets tricky. I would say small caps are just the traditional ways to value a stock are just much more important on that side. Like there's less room for error,
Yeah, it's not as easy just to raise a bunch of money. I'll give you
another one, and this is less a red flag, but more just something that you have to overcome. Like your chance of cloning on microcap, small caps is like almost zero. Like no big investor is gonna have a position that makes you feel better that okay, at least I got the same thing as him. And like Micron, let's say, you can look at Li Lu and Monish and stuff like that, and you could literally just buy stuff because they buy it and you'd be okay, but you're not going to get that I'll call it confirmation bias. So it might be a good thing, but you won't get that from just buying microcap stocks.
Sure. Yeah.
And if you do go try to read message boards or something about a small cap stock you own, and you're better off not doing it. It's like they all think it's going to go up 100 times or something like that.
The rose-colored glasses are especially rosy in microcap land.
Yeah.
Well, it's probably just because, at least with the mega cap companies, like you're gonna have analysts on both sides of things. You have a lot of attention, so you have a lot more people looking for flaws. Whereas all of a sudden you get some dude who invests in a microcap and now wants to make it known to the world, like he doesn't have much to counteract him, which I get what you're saying, but it makes sense that would be a problem, especially there, just because there's not a lot of people looking at it. What about what are some like maybe common value traps that you might run into? We kind of mentioned vaguely.
I've done them all, so yeah, I can talk about them.
The stagnant company, but is there like a specific trait of management that you look for, or something like that would continue that stagnation, or something like that?
Wait, so you talking about value traps or management traits?
Well, it's kind of both, right? Because management could be what's causing it to be a value trap, or however you want to answer that question. I guess they're both relevant.
Okay, so management, I think, can only be judged by results. You can't listen to the story in general, because they're all the CEOs and stuff. They're charismatic. They're
good at that.
They're great at making excuses, making you feel great about the stuff. You have to go back. What did they say was going to happen? Then, fast forward what actually happened, how close are those two things, and that's, sure. I feel like you have to judge results based. And, I'll tell you one too, huge red flag is if they tout EBITDA. Okay. And I can give you the Charlie Munger answer, but you told me I can't curse, but he has his opinion about
adjusted EBITDA. Adjusted
and
EBITDA.
now you have things like adjusted EBITDA, which is adjusted BS is according, so it's crazy to think that, we talked about debt already, but to think that this is my earnings, but I'm not going to count any of my interest or debt, and then I'm also not going to count any of my depreciation, and so that's maybe you could not count depreciation if you instead subtract out Capex, but still,
sure.
Now you got to be worried about deferred capital and stuff like that, because
right, especially if it's a capital intensive business.
Right? Yes, and there are very few companies that spend more on or that spend less on Capex than they actually depreciate. Did I say that right? Yeah, like most, even though they don't want to admit it, most companies have to spend more on Capex than they're depreciating, So everybody thinks depreciation is a paper loss, and in something like real estate, it is, right? Where where your property is actually appreciating, but you're getting a write-off, 1/27th of it, every year. It's awesome.
Right.
But
you still have Capex there, and real estate's very capital intensive too.
Yeah. Yeah. So that's one red flag. Value trap. I feel like the tale as old as time. Value trap is misjudging recent earnings. And that's what I've gotten hit by the worst, I think, is thinking that recent upticks, let's say, are going to continue, are the norm, moving forward.
I've been burned by that too.
And I think, well, I'll give you, and I can tell you, I'll use Smith & Wesson as an example, because I was big on that. I have a few videos on them, and I'll tell you the exact earnings call quote that made me like sell it like after hours. And this is a true story. As much as I love the company, I'm sitting there listening to the earnings call, and they had announced after earnings, and they were talking about what were they saying? They kept on talking about, well, yeah, but we're still projecting cash flow of this. And I'm sitting there, because they had reported a negative earnings or something very small, and I was like, this is weird. They were doing so good. Ruger had done good. All the other,
was that a couple of years ago or a year ago?
It was like, I don't know,
I recall
several quarters ago.
They were very positive. Then all of a sudden it was like a little bit.
Yeah. So
I remember that. Yeah.
And I had my metrics that I would track, like the adjusted NICS number that the FBI posts every month. Mm-hmm. And I was like, okay, as long as I watch this, I'm good, because this is total gun sales. Okay. So anyway, all that leading up, and they had this crappy quarter, and which, I'm not going to judge somebody on a quarter, right? But they kept on saying, well, full year, our cash flow is expected to be this, our cash flow is expected to be that. And it was a pretty good number. And I was like, okay, I'm fine holding it with that projected cash flow. It's nothing big. And after the call, one of these bankers asked, hey, whenever y'all said cash flow, I just want to make sure that y'all mean free cash flow. And the VP, this lady, was like, oh, no, that was just operating cash flow. Like, we're actually projecting negative free cash flow. And I was like, you got to be kidding me. I was like, and so anyway, from that to me was like dishonesty, or maybe it was, there was a bunch of stuff.
It's a half truth
with Smith & Wesson. Yeah, I think
half truth.
There was a huge boom during all the riots and stuff, then there was it had really come down, and it was selling.
It pulled forward a lot of earnings. It pulled forward a massive amount of demand. I mean, you saw that with a lot of industries in 2020, 2021.
But I would say with somebody like Smith & Wesson, like, that's also the benefit of buying a company with a very good balance sheet, though, is because even whenever earnings went down, the stock didn't. I mean, I think it didn't go to zero. I think it went. So that's, speaking of downside protection, I think it's very important to keep that in mind whenever you're looking at small, just any stock, but especially small caps, because there's a big difference between losing 25% of your investment and losing 100%.
Yep.
And so that's all I can think of for red flags right now.
So that's I like the way you framed that, with the big red flag is overemphasis, or not red flag, but the value trap is overemphasizing recent earnings for whatever, and really in either direction, I guess. But that makes a lot of sense. And when you factor in all the other things, when you're evaluating management, like their historical performance, are they doing what they say they're doing, and all that good stuff, it makes a lot of sense when you put it all together. I got some questions here from Tony. They're asking how much you concentrate your portfolio, if you're willing to share, maybe how you balance that.
I think about a lot before I buy. Yeah, concentrate. No, I'm just kidding. So I feel like there's multiple ways to. I was thinking about this earlier. So I usually I'm comfortable going very high, because I don't have debt, right? So if you don't need the money, and if you feel like you're saving enough that, like, let's say that you're saving enough a year to where you're going to increase your portfolio by 10% a year just from savings or something like that,
Right.
then I feel like putting way more than that is okay. I mean, I've had something over 50% of my portfolio, and it actually, maybe it was a curse, but it did really well. So now I'm kind of tempted to do that again, but I haven't done it yet.
Sure.
I think right now my biggest is probably 25%. Yeah.
Okay. So, yeah, that's definitely concentrated.
And I think I only have like 6.
But it's a sliding scale. Obviously, as the portfolio grows, you have more to protect. So you probably opt towards more diversification. But when you're, if you're smaller, its concentration seems like it would make some more sense because it's actually going to move the needle more,
Yeah, I think the more diversified you get, the more you have a reversion to the mean.
Right.
So I think, and I also think that it's very hard to keep up with 20 companies well.
That too. Yeah, when you're picking, at least, you run into that too. But yeah, and plus, when you get really big, you have the universe of opportunities problem that Berkshire and those folks have to worry about because they've got so many billions to move. Investing in a great $500 million opportunity doesn't do anything for them, so they don't do it. So back to kind of what you were saying earlier, you have the advantage as an individual investor. One of those is opportunity size. That $7 million nano cap actually can move the needle for you, but Berkshire wouldn't do that ever, So
I think one of the well, I'd switch subjects a little bit, but one of the biggest advantages of individual investors is, and it's one of the hardest ones to practice, is just patience and time. Because
answering.
I think the way that mutual funds are set up and stuff like that, they're forced to buy high and sell low, because to get published on like quarterly, monthly type newsletters and stuff like that, and people will flock to the high performers. So even if you're a good mutual fund manager or a good, active investor, now you get all this money whenever all the stocks that are up high. So what do? You put money into what which is higher than normal. And the people who are having down quarters or down months, everybody's like, oh, this guy sucks. I need to go somewhere else. And so he's forced to sell low. And I think that it explains a lot of the underperformance of Wall Street. And I feel like that's a big advantage of the individual investor for sure.
Yeah, not answering to people. That's one thing I noted. I mean, we were at Berkshire together. There were a lot of people, and Charlie Munger commented on it too. But everyone wants to be a wealth manager. Everyone wants to have a fund, especially a lot of the younger people I met. I would lump myself in there, but a lot of people they want to do they want to run their own fund, and it's like that's a totally different ballgame than managing your own thing, because you're dealing with other people's emotions now, and dealing with your own emotions is hard enough. But now you're worried about other people. It gets very dicey, especially as it expands out to more than just a few people. And even then, if you had your mother's money in your family office or whatever, you're probably going to behave quite a bit differently than if it was just yours, most likely. Maybe not if you're stoic, but it's very different.
You would guaranteed behave differently, and that's
right.
If you manage your own money well, even if you start with a small sum, you won't have to worry about finances in 10, 20 years. And you don't need anybody else's money to manage. If you get like what some of those people get, 20 to 30 to 40% returns, 26% is 10x in 10 years. So think about if you start with 120 years, that's $10 million, which it's tough to get 26%, but I think it's easier to do it with your own money than with somebody else's.
Right. So, sure.
Yeah.
So speaking of Berkshire, do you have what were your kind of key takeaways from the meeting or that weekend or everything around the weekend?
I did.
I know you were taking notes next to me at the meeting.
I actually only took 2 notes, and then I just kind of like enjoyed watching it.
Yeah.
My key takeaway was, all this longevity stuff. What I think, if you just stay mentally sharp like Charlie, maybe you can live to 100. That's
that's the key.
Because I was just thinking that the whole time. I'm like, I can't believe this guy's 99 years old, and he's like the funniest guy in the like, I don't know, just quick still and everything.
Even if he wasn't quick, just talking for 6 hours in front of 30,000 people is impressive.
Yeah. So I kind of liked his quote. Warren said something like, for the longest time, and I guess it's still the case, the value of real estate is whatever the most somebody can borrow for it, like
without putting their name on it.
Yeah, exactly. And that's right. If you think about,
that's kind of everything.
Yeah. Think about, like, if you're gonna go into debt or like you're gonna start this LLC to open an Airbnb or something like that. And I mean, if it goes under, let's say you put down, some people it's a very small amount that you put down, and it's you don't care if it goes bankrupt or not, it doesn't.
Well, you care, but not as much as.
But you care, but like it's not going into your own.
Right.
Yeah. I kind of liked his talk about banking. So he talked about because I'd always wondered that, like, how the Fed bailed out all those deposits on, what was the name of that bank?
Silicon Valley.
Yeah, that's it. Silicon Valley Bank. They bailed everybody out, and even above the $250,000 limit. And like the free market person in me was like, this is government interference. This is.
No, it definitely was.
Yeah, but he kind of he put some good perspective on it, that it would have been contagious and we would have had another disaster, and then he also had a good solution, because my take was like, what if they wouldn't have done that? Now banks are incentivized just to take high risk and stuff like that, because they know that if they fail, at least they're not going to lose people's money. So why not take high risk investments and guarantee a high interest rate on your savings account? And his answer was that he thinks that that banking CEOs and stuff should be held accountable, or have their net worth wiped out and even go to jail. Like in my industry, like if something really bad happens, because we work with highly hazardous chemicals and stuff like that. I mean, there's some really bad things that can go wrong. I mean, and it's understood that people in certain positions can be held personally accountable and serve time and stuff. And I feel like that same mentality needs to go in the financial sector. And I don't think anybody in the financial sector would like to hear that. But
and the lobbies are doing well. So
yeah, but now we're getting that's politics.
We're getting a little pessimistic here. But yeah, it makes sense. There's two sides to the coin, I think, is really all it is. It's like, yeah, you can let the bank go under, but then there's going to be consequences there. Just as if you bail it out, there's going to be consequences there. There's always consequences. Nothing's free.
Yeah.
And anything else then? Just even from the greater weekend, not just the Q&A session.
No, I'm hoping I go back.
Yeah,
for the College World Series. Yeah,
both of our.
No, I'm going back. I'm definitely going back for Berkshire, but I hope I go back in a few weeks for a College World Series. Yeah.
Oh, sure. Yeah, you're an LSU
We'll see.
guy.
We'll see if they make it. Yeah.
I forgot about that. Omaha's a weird place. It's basically College World Series, Berkshire, and I think they do concerts, and it's just kind of like an event place, I guess. There's, I don't know, and a lot of financials. So you have like obviously Berkshire, Markel, Mutual of Omaha, and all those folks. But it's a weird city. The economic mix is weird, I should say. Concentrated, right? It makes sense. Concentrate their bets on a few things.
Yeah, exactly. I was surprised by Omaha. I really liked it, so I'll go back. I'll definitely go back next year.
There was a really good energy just because of all the people there. I wonder how it is normally, but I was there kind of Sunday night, Monday morning, And it was weird how dead the downtown was on a Monday morning
compared to like Friday.
But even just in general, it was empty. It's just strange. So I wonder how much of their economy relies just on the big events. Probably a lot, but yeah. It means it's not that huge of a town. 30,000 people come in all at once.
I know the airport was tiny. I remember thinking that, and it was
wild.
It was a small airport. Okay, so let me ask you this, because I think it can tie into the micro cap, small cap discussion.
Sure.
How do you feel about options in general?
Oh boy, I know the people love hearing about this, right? I think they're a useful tool. I think they're more useful, at least in the value investing sense, when you already have a pretty sizable portfolio with a good amount of cash, at least on like the selling put side of things. If you sell puts at your target strike price, I think that's a very useful tool if you have a big pile of cash that's undeployed. And then on the other side, selling covered calls, which is where you sell at a strike price above your current price. If you're already fully invested, that could be a nice way to produce a little extra income for maybe a less volatile holding, or even a more volatile holding if you just set the strike price really high and you're like, if it gets to this price, I'm happy to sell. In the meantime, I'll take the premium. I think that makes sense. But I think people get really get themselves in a lot of trouble because it's just another form of leverage when they get into just naked calls, naked puts, especially deep out of the money with short expirations. Like it's getting pretty dicey there, and a lot of people lose a lot there.
So basically, your covered calls, protected puts, yes. Everything else, be worried about.
Sure. I guess you could say that. I think with any financial tool, if you don't understand it, just don't use it. There's plenty of ways to do it. And I think a lot of people don't understand options, especially selling options, selling puts, selling calls. It's kind of confusing. It took me a while to figure that out. But
and I'm going to tie this to the microcaps. But
go ahead.
I think that buying short-term calls and puts, or specifically calls, is probably, if you told me I had to invest and I had to lose my money as fast as possible, that's what I would try to do, So, my I guess in my great genius, I said, well, then that means that the best thing to do would be to sell short-term calls, and I'd lost my biggest point. I lost a huge position in Micron to a covered calls getting assigned. And I was like, and now it's like 70 or something now. But anyway, I was so excited about 2%.
I've never done a covered call. I have done cash secured puts just to try to work through the mechanics.
Oh, I was loving it. I was getting short-term Micron stuff, and then all of a sudden I had them tiered, But anyway, covered calls.
It's very active. It's very active.
It went at like 30%. I made like 2%, But anyway, the small caps. Every small cap I own, you go to the options tab. And this is probably a good thing, to be honest, for me especially, is that the options are
very illiquid,
almost non-existent. Yeah. And maybe you can buy leaps and stuff, but I feel like you're better off just owning the stock. My thing with options is that you got to get the value right and the timing right in a way, So it's like, I feel like it's hard enough to get the value portion correct, And one of my biggest positions that did really well, they actually got bought out, so I don't own them anymore. But I mean, if there was a chance to sell covered calls there, I probably would have done it. That was like a year or so ago, and But anyway, then you missed those huge run ups, because I think it tripled in one day from getting bought out, and I was lucky to not have it tied to any options. It was just so it was nice. Yeah.
Our man Luis left us a super chat here. Making money with options is easy. Just sell a course on options, and
that is the way to do it.
Luis knows.
That brings me, that makes me think about all the YouTube investing stuff and what it takes to be. I think it's sad how you could be a very successful YouTube channel by selling or by, I don't know, hype and selling stuff like
stocks.
that. Yeah.
Hype stocks, hype investments.
Or just making Baba videos. Every Baba video I made, I'm like, it would up my subscribers like, huge amount. And my wife's
you gotta tickle
make Alibaba videos, and I was like, I'm not doing that.
You gotta tickle the algorithm every now and then.
Yeah.
Here's your Baba offering.
Yeah.
Right.
So, okay, there's this comment from Hodo. It's almost Hodo Prime. Where do you like to buy in the company life cycle? Okay, so I actually have a note about this already about small caps. So I feel like, if you look at the company life cycle, the classic 4 categories are launch, growth, maturity, and like exit. I think of it as like, you're in like the idea, pre-profit, sometimes pre-revenue stage. Then you're in the, you're making money plus rapid growth. And now you're in, and then the last 2 are like the plateau, maturity, plus the and then the final one I would say is like optimization and value extraction. And
okay, no, that makes sense.
And I feel like those are 4 different companies or 4 different valuation philosophies that you have to bring to the table. So like, you can't use the same things to judge a, mature, let's say dividend paying stable company that you would, an idea pre-profit company. And I think that you can still find value on something that's not profitable yet, but that it's just way more difficult. So I would say, they asked where do you like to buy? I like to buy in the growth phase, and it can be something that's matured and then growing, because I feel like that. I don't know. I just think buying into something with growth makes your equation so much easier, because growth gets raised to an exponent in the equation, right? So if there's growth, it's just that is huge. Don't pay a price that's expecting a lot of growth, but buy something that you think is going to grow. And then the exit,
when you're relying on growth. Growth should be the gravy, ideally.
No, like I said, I think that you can get a long way by saying single digit PE, double digit growth. I feel like that's. And then the last one, the exit, or like I call it the harvesting. Like value extraction, where companies like mature, but they're buying back stocks, they're paying dividends. I feel like that's probably the easiest to get fair value on, because you can really kind of predict, future cash flows and stuff like that. But it's also
theoretically less unknowns.
It's usually not going to be at huge discounts,
Right.
I feel like you got a chance recently with somebody like Google, and I had it, whenever they were like in the 80s. But yeah.
Yeah, right. No, that makes sense. And that's maybe that's another value trap. We're talking about those, like when you see a lot of growth in recent earnings, and you just project that growth rate out indefinitely when it's real high, and they've never really proven that they've done that before. And even if they have, depending on how big the company is, how big the market they're addressing is, that can be an easy one to fall into, especially with these smaller businesses where it might be a very niche, specialized sort of company where the total addressable market is not $1 trillion. It might be a few billion. And so you got to keep that in mind too. Like they'd have to diversify out into a different product, and then who knows what the growth rate is there. So then you're bringing in all these variables to worry about. So yeah, it makes sense.
Oh, go ahead.
I was just going to say, any final thoughts on microcaps kind of before we wrap up? Take a quick look through the comments. I think we had a few. I think we had all the questions that people were asking.
Yes, I had one more thing that we haven't talked about.
How about it?
Your chance of competition invasion is much higher in small caps. So you got to think that like it's just much more easier to compete to start up, or somebody. There's usually higher competition, I would think.
I think that's industry dependent. Is it really size dependent?
I mean, if you have something making 30% return on assets,
it's going to attract big players.
it's going to attract somebody to say, hey, bank, look, I can make 30% on my money.
Yeah,
and
I guess
they
right.
get it. So I think in general, return on assets tends to all converge on so that's it though. That was just something
that makes
else
sense
that I wanted to say. I think we covered most of it.
There's a lot of things to worry about, right? That's why investing is it's so easy, but it's so hard. Because there's a lot of moving parts, and of course you always have the emotional factors in it. And when you might be in a very volatile holding like a microcap, it just kind of expands all that with all the different factors. Anyways, I appreciate you coming on, Patrick. Finally, at long last, had you on Punch Card. We'll have to have you back again sometime, if you're willing, of course. If this wasn't too terrible,
We'll
get some more characters on for you next time. Would have been nice to have. Would have been nice to have our man Frank here to join the Microcap talk. I know he's very big into that as well.
Yeah, I talked to him about that boating company. I have a video on them too.
Mm-hmm. Yeah. Which one is that?
One New, ONEW.
Did we talk about that on the show at some point? No,
I think so. He had a big Twitter thing on it. And
it was a tweet. I'm thinking. I forget if we talked about it on the show, but I remember seeing him, or I remember him talking about it. But yeah, anyways. For those of you who want to check out more of Patrick's stuff, he's got the Part-Time Investing YouTube channel. So Part-Time Investing is the name of the channel. So go check that out, please. He's got a lot of good stuff. If you liked anything about what you heard here, and like I said, we'll try to have you back at some point in the near future. So thank you, Patrick, and thank you everyone for stopping by at this new time. If you're in live, we'll be switching around the time a little bit here and there. Probably have some more around this time in the near future, and have some more at our kind of regular time again in the future as well. So with that said, like, comment, subscribe, all that great stuff. And until next time.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.